In the high-stakes world of pharmaceuticals, some of the biggest risks aren't found in a lab. They're sitting right there on the balance sheet. So today, we're going to put on our accountant hats and tackle a really tough question. How do you actually put a number on ethical failure? Let's get into it.
Okay, just imagine you looking at a financial statement and you see this number, $2.5 billion. And it's not revenue, it's a fine. As an accountant, what do you even do with that? Where does that go on the income statement? What does it tell you about the company's real health? You see, this isn't just a legal problem, it's a massive financial event, and it's born from a breakdown in ethics.
And really, that's the heart of the matter. These absolutely staggering losses are a direct result of huge legal and reputational risks. We're talking about bribery and corruption that can shake a company to its core. And that's where you come in, understanding how to account for it and, hopefully, how to spot the red flags ahead of time.
So how do we get a handle on this? Well, thankfully, there are standards built for exactly this. We're going to break down two key disclosure metrics, and I want you to think of them as two sides of the same coin. One is kind of like the fire alarm. It tells you how bad the damage is. The other, that's the fireproofing. It's designed to stop the disaster from ever happening.
So, let's start with that fire alarm. This is the metric that's all about quantifying the fallout after things have already gone sideways. It's the reactive part of the story where we follow the money after a crisis hits.
And here it is in all its official glory, HCBP 510A.1. Basically, it's a rule that says companies have to disclose the total amount of money they've lost from legal battles over bribery and corruption. The key takeaway here is, this isn't optional. It's a required disclosure of the cold, hard cash that's gone out the door. Now, for an accountant, the details here are everything. So what exactly does this number include? Well, as you can see, it covers the direct penalties, the fines, the settlements, the restitution payments. But what's just as important is what it doesn't cover. Things like the internal costs of hiring lawyers. For you, getting that distinction right is absolutely critical for a correct disclosure.
So, what might this actually look like in a company's report? It could be a simple, stark number just like this, 10 million US dollars. Maybe that represents monetary losses from, say, 3 different legal cases in just 1 year. This is the number that basically screams governance failure.
But it's not just about the number. A company can't just drop a multi-million-dollar loss in the footnotes and call it a day. No, they also have to provide the story behind it. Was it a settlement, or did they plead guilty? Was the problem bribery, or was it fraud? And maybe most importantly for assessing future risk, what are they actually doing to fix the problem?
Okay, so that was the fire alarm. But a good risk strategy isn't just about putting out fires. It's about preventing them in the first place, right? And that brings us to our second metric, the fireproofing. This one isn't about counting losses. It's about auditing the very systems a company builds to make sure those losses never happen.
Officially, we're talking about HCBP 510A.2. Now, this is a qualitative metric. It requires companies to describe their code of ethics. This is where a company has to put its promises down on paper, specifically about how it deals with the doctors and pharmacists who actually prescribe their products.
And we're not talking about some vague mission statement here. The code has to get specific. It needs to have clear rules on things like providing food and entertainment, sponsoring training, or having employees sit on powerful committees that decide which drugs get approved. Every single one of these is a potential backdoor for corruption if you don't govern it properly. Let's be real, a code of ethics is pretty useless if it's just gathering dust on a shelf. So this metric also requires companies to detail how they make it real. How is it enforced? What happens if someone breaks the rules? And how often are people actually trained on this stuff? If you're an auditor, these are the exact questions you should be drilling down on. So, when you put these two metrics together, you get a really complete picture. Metric 1 is quantitative and reactive. It's looking backwards, signaling a past weakness. Metric 2 is qualitative and proactive. It's looking forward, signaling potential future strength. One measures the cost of failure, the other audits the promise of integrity.
All right, let's bring this all home. Why does really getting these two metrics matter so much for an accountant, an auditor, or even an investor?
Because this is your playbook. If you're an accountant, you're the one booking the provisions for these massive fines and figuring out the costs of compliance programs. If you're an auditor, you're on the front lines. You're verifying the litigation records and you're reviewing that code of ethics. And hey, if you're an investor, these metrics are crystal clear signals of risk and reputational health.
And that's really the bottom line, isn't it? This isn't just about dodging fines. A strong, well-enforced ethics policy is a strategic asset. It protects the brand, it lowers risk, and, in today's market, it directly boosts a company's value by making its ESG profile that much stronger.
Which brings us to a final, really important question for anyone in accounting today. In a world where intangible things like reputation are more valuable than ever, our jobs have to evolve. It's not enough anymore to just verify the numbers on a spreadsheet. The real challenge is this, and I'll leave you with it. When all the numbers look clean, how do you audit a company's character? Thanks for joining this explainer.